Silver just crossed a threshold that almost nobody saw coming. Solar developers around the world are quietly locking in silver contracts years in advance, and the numbers coming out of this sector are starting to terrify people who actually understand supply chains. If what is unfolding right now continues at this pace, the silver market could face a shortage unlike anything we have seen in modern history. Today, we are breaking down exactly why record solar demand is colliding with a silver supply system that is already stretched to its limit, and why some analysts are now floating a number that sounds almost unbelievable: $180 an ounce. Stick with me to the end, because the second half of this video covers the scenario that could either make this the greatest wealth transfer of the decade, or expose investors who moved too late. Let's start with the foundation of this story. Silver is no longer just a monetary metal sitting in vaults. It has become one of the most critical industrial materials on the planet. Every modern solar panel requires silver paste to conduct electricity efficiently. There's currently no scalable substitute that performs at the same level. As governments across Europe, the United States, and Asia race to expand renewable infrastructure, solar installation numbers have shattered previous records year after year. But here's what almost nobody is talking about. The growth in solar capacity is not slowing down. It is accelerating. China, the largest solar manufacturer in the world, has continued expanding production lines even as global silver inventories shrink. India has announced massive new solar targets tied to energy independence goals. The European Union, still scarred by the energy shocks of recent years, is pushing renewable adoption harder than ever to escape dependency on unstable energy imports. This is exactly why smart money is moving early. Every one of these solar expansion plans requires silver, and the demand curve is not flattening. It is climbing into territory that the market has never had to absorb before. Now layer this industrial demand on top of an already fragile supply structure. Most silver does not come from dedicated silver mines. It is produced as a byproduct of copper, zinc, and lead mining. This means silver supply cannot simply increase just because prices rise. Mining companies cannot flip a switch and produce more silver on demand. The metal arrives only when these other base metals are extracted, regardless of how desperate the market becomes for silver itself. This structural rigidity is one of the most underappreciated risks in the entire commodities space. Now pay close attention, because this is where the story gets serious. For several consecutive years, global silver demand has outpaced mine supply, creating what analysts call a structural deficit. Above-ground stockpiles, the buffer that normally absorbs these imbalances, have been steadily drawn down. When you combine years of deficits with a surge in solar-related industrial consumption, you get a market where every new wave of demand has less and less metal available to satisfy it. Meanwhile, COMEX vault data has shown registered silver inventories tightening at moments when delivery demands spike. When physical metal available for delivery shrinks while paper contracts trading on the exchange remain enormous, the system becomes vulnerable to sudden price dislocations. This is the exact mechanical setup that has historically preceded violent upward repricing events in the silver market. Now let's bring in the macro backdrop, because silver never moves in isolation. The Federal Reserve and the European Central Bank are both navigating an extremely delicate balancing act. Inflation has proven far stickier than officials hoped, even as growth shows signs of fatigue. Every time central banks hint at rate cuts to support struggling economies, real interest rates fall, and that environment historically favors precious metals. Currency devaluation concerns are intensifying as well. The euro continues to face pressure from energy dependency and fiscal strain among member states. The dollar, despite its reserve currency status, is contending with mounting government debt levels that raise long-term questions about purchasing power preservation. This changes everything for silver investors. When confidence in fiat currencies weakens, capital does not just flow into gold, it increasingly flows into silver, because silver offers both a monetary hedge and direct exposure to the booming industrial growth story. That dual identity is precisely why silver has historically outperformed gold during the later stages of a precious metals bull cycle. Institutional positioning data backs this up. Large funds and commercial players have been adjusting their exposure in ways that suggest growing conviction around higher silver prices over the medium term. When professional money begins repositioning quietly ahead of retail recognition, it often signals the early innings of a much larger move. Geopolitical risk adds another layer of urgency to this picture. Trade tensions between major economies continue to threaten global supply chains, and any disruption to mining operations or metal shipments could tighten the market even further. Sanctions, export restrictions, or instability in key mining regions could remove meaningful supply from the market overnight. In a market already running structural deficits, even a small supply shock could trigger an outsized price reaction. So where could this realistically go? Let's walk through the scenarios. In the bullish case, solar demand continues accelerating, while mine supply remains structurally limited. Central banks ease policy to support weakening growth, real rates fall, and capital floods into both gold and silver as inflation hedges. Under this scenario, sustained deficits combined with monetary tailwinds could push silver toward price levels that look extreme by today's standards, including the much-discussed $180 target some analysts have floated for the years ahead. In the bearish case, a sharp global recession could temporarily crush industrial demand, including solar-related silver consumption. If central banks are forced to keep rates elevated longer to fight inflation, it could create short-term headwinds for precious metals broadly. Silver could see sharp corrections along the way, even within a longer-term bullish structure. This is the part most content creators ignore, because volatility cuts both directions. Smart investors are not betting on a straight line higher. They understand that silver could see brutal pullbacks of 20 or even 30% during this transition, even if the multi-year trend remains upward. The investors who succeed in this environment are the ones who understand the difference between short-term price swings and the long-term structural story. What happens next could shock most investors who assumed precious metals only move slowly. Markets defined by structural deficits do not correct gradually. They tend to stay calm for extended periods, then move violently once the imbalance becomes undeniable to the broader market. That is the pattern history has shown repeatedly in commodities facing supply-demand mismatches of this scale. So let's bring this together. Solar energy expansion is creating a demand shock that the silver market was never designed to absorb easily. Mine supply cannot respond quickly because most silver is a byproduct of other metals. Years of deficits have drained available inventories. Central bank policy, uncertainty, and currency devaluation concerns are pushing capital toward hard assets. Institutional positioning suggests professional money is already preparing for higher prices, and geopolitical risk adds the potential for sudden supply shocks at any moment. None of this guarantees silver reaches $180 on any specific timeline. But the structural forces driving this story are real, measurable, and accelerating. The investors who understand this early are the ones positioning themselves before the broader market catches on. The ones who wait for confirmation in the headlines often find themselves buying after the easiest gains are already gone. If you found this breakdown valuable, make sure you subscribe and turn on notifications, because we are tracking this story closely as new data emerges. Comment the word silver if you believe this market is heading toward a historic repricing. Comment the word gold if you think the broader precious metals complex moves first. Stay sharp, stay informed, and we will see you in the next one.